Well, I make it about 1 o'clock now, so I think I'm just going to get started. If everybody can hear me okay, see me okay, can you just say something or put something in chat, please? Great. Okay. Thank you, Mr. Mohammed. And thank you, Mr. Khaldoon. Okay, so I'll start with files. And assuming everybody can see, we'll get cracking. So everybody see the slides okay? Anybody not see?
No slide, Michelle.
Okay, that's strange. Don't know why that's not working.
I think Agassi is there. He can help you. Agassi, if you can help Michelle to view the slide.
Or should I do it through screen share?
I think, Michelle, you have to switch off your cam and put instead of the slide, okay?
Okay, sure, will do. I'll try that. Thank you. Sorry, I just never used this before, so. Yeah. So what about now? Anybody see these slides?
No slide, Michelle, huh?
That's strange. Okay. Let's just try it through screen share then. Sorry. They did give me a tutorial. They told me, you know, I should be able to just go straight into files.
Now everything is okay, Michelle. You can go.
So what about now? Can we see this screen? Anybody?
I think you make a share screen. You can open your file in your desktop.
Yeah, that's what I'm doing. But I mean, can you actually see it?
Okay. Agassi with us, Agassi?
I hear you clearly.
Yeah, that's not the issue. I think the issue is just nobody can seem to see the file that I would like to share. Because I have it on my screen now. But it doesn't seem that anybody can see that.
Can you hear me?
Yep, I can hear you. Mr. Ahmed, yes.
Yes, yes. You have shared your screen, but just screen. You have to share your files. Please check the screen share. Okay. Yes, yes, yes. Choose the files. Now choose your file you want to present from your desktop. Okay, we can see it. Just maximize it and we will see.
Right, okay, great. Cool. Thank you. Sorry about that. So everybody else can see, yeah?
Yeah. Yes.
Okay, perfect. Yes. Thank you very much. Great. We'll get started then. Sorry about that. That's my fault, starting slightly late. The topic for this presentation is production inflation and its impact on financial markets in 2021. We're going to be talking about production inflation specifically, but also a little bit about more general inflation. And specifically, we're going to be looking quickly at how this affects us as traders of CFDs, particularly CFDs on commodities, but also other CFDs on the dollar, on large cap shares and other instruments. My name is Michael Stark. I'm going to be presenting this presentation today. I work for Exness in the Trading and Quality department for about 2 years and about 5 years in total in CFDs. Been trading CFDs about 7 years now, roughly, and I'm an associate of the Society of Technical Analysts. So my main focus generally is on charts. I usually prefer to look at indicators, price action, and so on. I think this is more useful for the average trader. But today we are also going to be looking a bit further ahead in the year at some events that might occur and might affect markets. So we're going to be looking at fundamentals primarily and then charts. And I would encourage you, if you do have any questions about anything that I say in the presentation, you are very, very welcome to ask all your questions at the end. We will have plenty of time for questions. This is just a short presentation. So before we start, I need to remind you, if you do trade, you need to consider your experience, as CFDs involve high risk of loss. Trading is not suitable for everybody. None of the information here is a recommendation to trade anything. This webinar, this presentation is for educational purposes only, and any financial decision you make is at your own risk. I'm not telling you. So the general situation that we have, and the basic reason why we're having this presentation now, is that financial markets are forward-looking. They typically tend to look forward about 6, 8, 10 months, roughly. And that's the situation that we have now. Markets are generally behaving as if the coronavirus is over and everything is back to normal, when actually it's not necessarily. And there is high uncertainty remaining over to what extent vaccines can be rolled out in the time that everybody expects. Are there going to be sudden upsurges in cases? What other measures are governments possibly going to introduce or relax, for that matter, related to the lockdowns and other economics? But the key measure that we're looking at is stimulus, specifically fiscal stimulus in the USA, which is likely to push shares, indices, possibly commodities higher, but it could be negative for currencies. That's one of the key factors that we're looking at when we're discussing inflation today. So it's generally not guaranteed that we're going back to normal in the next couple of quarters. It looks fairly likely that we will return to normal this year, but it's not absolutely certain. And markets won't go up forever, but still the crash probably isn't coming this year, at least. When I say the crash isn't coming, eventually there probably will be another crash, just probably not within this year. And politics is the key thing that's certainly been in focus recently. That is going to have quite a significant effect on inflation, we expect, this year. With President Biden having been inaugurated on 20th of January, he's generally returned things to normal. Compared with Donald Trump, his predecessor, he is less of a character, let's say. He's more of a normal, level-headed politician. He's returned to normality in terms of negotiations with Iran and the Paris Climate Accords. And these things are likely to have some effect on commodities, not necessarily right now, but if Iran increases production of crude oil after having harmonized to some degree relations with the West, and if there is less demand for oil as a result of climate measures, then we can probably expect the price of oil to go up. Not necessarily now, but something we can look for in the future. And with the Democrats in charge in Congress, they can basically do whatever they want. And that's going to be relevant, particularly for fiscal stimulus. They can legislate pretty much however they want. They don't really need to think about the Republicans, and what they think about various laws that the government wants to make, which is not at all the same as the situation we had in the previous term for the Republicans. The American government is seen as strong, and the Democrats, having moved fairly far to the right over the last 20, 30 years compared with where they were, are widely seen by Wall Street traders, investors as being business friendly, but government debt is still extremely high. So the bottom line is, it looks like American politics are going to be more stable. We focus primarily on American politics because it is, like it or not, the center of financial trading in the world, New York particularly, and most commodities that we're going to be discussing later are priced in US dollars. And if we look at the general economic policy in America specifically, but also in other countries, it's very likely that the trade war started by President Trump is going to continue to calm down. The current tariffs on products like soybeans and various finished goods and so on between America and China are likely to decrease, And generally, it's likely that trade is going to start returning to normal. This is likely to be something positive for commodities, given that China is the leading importer of raw commodities, especially crude oil, iron ore, and so on, world. And of course, it's likely to be positive too for various emerging currencies such as the Lira, South African Rand, Baht, and so on, since various emerging economies, their main trade partner in terms of exports of materials is China. The American government is also not planning to reverse Donald Trump's tax cuts, something that's likely to be very positive for most major corporations and indices for that matter. And finally, the key point that we've seen in politics, general economic policy, is that the federal minimum wage in America is likely to go up to about $15 an hour, which could be quite significant for inflation, given the fact that there will be more money in the economy, people will have more purchasing power. And it's something that also could be quite negative for many traditional defensive shares, given that the employees of companies like Walmart or any number of other traditional shares in defensive companies, these employees often work on minimum wage. Whereas if we look at cyclical shares as opposed to defensive, so primarily tech, then we can expect it's not really going to offer much difference. It's not going to be a strong factor. It could be slightly positive because very few employees in the USA, that is, of companies such as Apple or Tesla or you name it, any other tech, they don't really work for minimum. So all of these factors together, they do raise the possibility of inflation being higher, and they raise the possibility of trade getting better and exotic currencies, emerging currencies, making some gains. Now, looking at fiscal policy specifically, the government in America has no plans to stop the current program stimulus, which is a $600 check, and they're also planning as a top priority the new package worth $1.9 trillion, nearly $2 trillion. That is the top priority for President Biden. And that is a lot of new money to come into an economy. It really is a lot, especially after about a year of monetary stimulus being basically unlimited, going on and on and on. A huge amount of new dollars having been created in the economy. And the Federal Reserve System, meanwhile, they abandoned the clear target for inflation last autumn, in October, I think it was, at the Jackson Hole online summit it was. So while the government is primarily concerned with getting people back in work or getting people out of poverty as a result of the economic downturn, they don't really care about inflation. But commodities generally, particularly gold, silver, oil, are very sensitive to the early stages of inflation, something that's likely to be triggered by the sheer volume of stimulus that the Americans to further. And looking at monetary policy as well, this is more of a wild card than some of the other factors. Certainly, if talking about this 6 weeks ago or even a month ago, nobody would have expected that the Fed could have raised rates this year. It looked impossible. But now it does look less certain that is the case. People are starting to expect that the Fed might raise rates as a result of inflation higher, and that might even trigger a repeat to some extent of what happened in 2008 as debt gets more expensive. I don't think that's very likely personally, but this is an opinion that you're hearing quite a lot nowadays. And if we look at the Federal Open Market Committee, generally the senior members of the FOMC, they've discounted the possibility of 2% inflation in a sustained way this year. That is, ongoing this year, which is quite probably right. They know what they're talking about, but still we can expect inflation to rise. And in general, decreasing quantitative easing does look unlikely this year. We don't think that's something that's very likely, but it remains possible. It's just not certain. We don't actually really know what's going to happen in the way that we might have thought we did a year ago. They could raise rates, but then at the same time, there's a big risk doing that this might hurt the fragile economic recovery, which is the case in the USA. In other countries, it's not so fragile. In America, it could be very, very damaging if they were to raise rates. However, I don't personally think it's very likely, given they've abandoned their inflation target, and we don't really see inflation rising that high this year. Now, quickly, we're going to slightly sidetrack and talk about the dollar. We can see that bond yields have increased from a trough in the middle of last year. In August last year, see that bond yields on the 10-year Treasury bonds in the USA, that is to say, were about 0.5%, which is one of the lowest figures for quite some time. Yet at the same time, since then, since that depth of the crisis in some respects, see that it's been increasing steadily. The yields from bonds have increased fairly steadily, up to about 1.1% at the start of this year. This chart is from, I think, about 2 weeks ago. So that suggests increasing demand for the dollar. And it also suggests that people are more likely to buy the dollar to buy bonds than certain other currencies. I'm thinking mainly about the euro and the yen here, because European bonds are almost always still basically zero, or in some cases negative. And Japanese bonds certainly aren't. And 1.1% is much, but it still is something that might encourage some just to buy the dollar. And that's one of the reasons why we think that the dollar probably isn't going to continue downward much further against most currencies. There might well be a bounce. The flip side to that is that the carry trade, which had previously been quite positive for the dollar, especially against the yen, is now negative because rates in America, the Fed's funds rate is now 0 to 0.25%, one of the lowest. And many emerging economies retain quite high rates. Turkey 17%, South Africa, Mexico, I think they're still 4.25% each. So a negative carry trade for the dollar looks like the name of the game this year. Something that, would have seemed very unlikely about this time last year. There we go. And another factor in favor of the dollar is that various large cap American shares are still popular, and people, so the orders for these, they need to go through the NASDAQ or the NYSE or whatever exchange, and people need dollars to do that. So in general, we can say about the dollar that there is negativity, and especially if the value of the dollar is impacted by the stimulus, that is something that's quite negative. But definitely we're less negative on the whole than we were in the fourth quarter of 2020. That's something that we can certainly say. And looking at inflation specifically, firstly, let's talk about on the right, we've got market manufacturing purchasing managers index, having hit a low in April, we can see that that has also in a sustained way increased. It increased over the rest of last year and the start of this year. And particularly if we look at the figure for January for last month, that's actually the highest on record. That's the highest expansion in production activity in the USA since the figures began in 2012. So that's quite big. As activity expands, as purchasers buy more and more raw materials, that drives the prices up. And at the same time, there isn't really much that can be done in the current circumstances to get the prices back down again. This is likely to be a big factor for gold and silver, especially for oil less so, but for gold and silver, we're going to look at the charts in just a few minutes for that. And looking at consumer price index, we can also see that going up and up and up. And while the FOMC, since that is the trough, which we can see in April, FOMC, they expect 2% sustained inflation, likely, probably correct. But we can certainly see that it's going up. And traditionally, commodities are very sensitive to the first stages of inflation, and inflation in the USA particularly, because they are priced in dollars. We can see similar situations to this happening in many countries around the world. China is the second largest economy in the world based on GDP, and inflation is also rising there, PMI there. But we're not going to look at that specifically because quite possibly the figures are doctored. But I'm not saying they definitely are, just quite possibly they are. So that's a factor. We can also look at PMI in other countries like the UK, like in the EU, Eurozone-wide, and in Australia, various other major economies as far as trading CFDs is concerned. The data show is basically a similar thing. So now that we've briefly discussed the fundamentals, we're just going to have a quick look at charts, and we're going to try to analyze what kind of effects in practice are these factors going to have on us when we're trading CFDs over the next few weeks and months. Main focus is going to be on commodities, but we are also going to have a quick look at shares and at Bitcoin, of course, everyone's favorite. So if we start with gold, we can see that the uptrend, this is a weekly chart, is certainly still active. There has been a lot of strength for gold, despite the fact that it reached its peak in August and it hasn't reached another all-time high since then. There still is no clear sign at the moment that there's going to be a crash in the price here. There is still reasonably strong demand for buying gold, not necessarily to push it up much further. So one of the obvious possibilities that we could look at is the previous all-time high, which was around $2,000 for a troy. That's something that seems to be favourable if all of these fundamentals we've discussed do actually coalesce, do together this year. But equally, there is the possibility for gold that it might go further than that, especially if we can see rising inflation combined with disruptions in terms of how vaccines are given out to people and combined with higher numbers of cases from new variants of COVID. Given that gold is traditionally one of the biggest havens, safe haven assets, the deliverable gold, and the CFD, of course, just tracks the price. So that goes up when deliverable gold goes up. And one of the traditional reasons as well for not buying gold, namely that it doesn't pay any interest, has been basically removed now because American rates are at zero. So there's basically no carry or swap. There is some still, but a minimal amount of carry or swap positions in gold. So it does look really quite positive, and sentiment, I think in general, remains quite positive. There just hasn't been any catalyst yet to push it up higher. Possibilities for that include data, and of course, they include confirmed passing of the fiscal stimulus in the USA, changes in sentiment, what's going on in stock markets, various other things. It's waiting for a catalyst, essentially, as we'll see for a couple of other instruments later on towards the end. And silver, this one is a little bit different because if you've been following the whole GameStop debacle, this is one of the instruments that they moved on to afterwards. So it's been going pretty hectic recently. But another factor that differentiates silver from gold that I think is often overlooked is it's used very extensively in industry and manufacturing, unlike gold. Silver, in the last year, approximately 40 to 45% of the total production of silver was used to make things like photovoltaics, biocides, parts for smartphones, and various other goods, which gold is used for, just to not quite the same extent. And silver's use by stackers does remain popular. So the question here, I suppose, is if inflation is going to go up, to what extent are people going to have stockpiled silver in factories beforehand? Because we can often see with inflation going up significantly, that commodities such as silver that are used in manufacturing, they actually go down in price because they're too expensive and people just cut their production. Doesn't look like something that's very likely to happen this year, but still it's a factor that we should have. And of course, if you choose to trade silver, you need to be very cautious. Don't forget your stop, because it has been extremely volatile relative to the average last few weeks. And if we look at Brent, it's basically the similar situation to West Texas Intermediate crude. If we look at Brent, that's been going up and up and up, but fundamentals are definitely quite a lot weaker here. We're aware that, of course, demand for fuel is low. It's likely to remain low for some time, particularly for aviation, jet fuel, and indeed from general transport. Although, on the other side of the coin to that, Chinese economy has recovered quite dramatically since the second half of last year. And that is one of the main destinations for crude around the world to fuel China's economy. So if that continues, and we also see inflation increasing as seems to be likely, we can probably expect possibly even surpassing its high this time last year. Again, it's a wait and see. Usually though, a market doesn't continue in the same direction forever. That's not very likely. We could probably expect it to consolidate in a more clear way than it has done so far. And the first cyclical share, I think let's just look at one cyclical and one defensive share. Apple has been continuing to make gains since summer last year, just not hugely strong gains. If you look especially at October, November, and the first part of December, it didn't actually make any new highs. One of the factors behind that, of course, is that it's enormously more difficult to move of Apple up by 1-2% than it is a small growth share. And another factor is that interest had shifted decisively towards Bitcoin at that time, and overvaluation. I don't know Apple's PE offhand, but I think it's probably about 30 or 40-ish. Somebody maybe that later. So by that measure, it definitely is overvalued. Still, it has gone up. It's reached a new high after that, because in keeping with many other shares, there's just not that many places now for people to put their money. You're not going to put savings account because you don't get any interest on it anyway in So people are increasingly putting the money in shares as an inflation hedge, yes, but so as a way to get some sort of return, which you couldn't do with savings certificates. And defensive shares, this is just my opinion, have actually been more interesting, I think, the last couple of months. This is Bank of America Co-op, and we're on the daily chart again here, quite a short time frame. Still, that's made really quite big gains. It hasn't reached a new high, but as banks are returning to profitability and as markets generally seem to see the light at the end of the tunnel after COVID is over, these kinds of shares and also shares in oil have recovered quite significantly. So for traders of CFDs, we can probably expect quite a lot of attention on these opportunities, probably corrections over the next few weeks and possibly months, if attention continues to shift somewhat away from tech among large participants in markets. And finally, we've got Bitcoin. Everybody just loves this one. This is, just look at that, there's a parabolic curve. If we were on the shorter time frame, the daily chart, then we could see quite clearly where the parabolic curve has been broken. I mean, it has been broken here, but it would be clearer, of course, on a daily chart. Many people have been expecting after that happened, it would do the same as in 2017, as in 2011, and it declined by 80%. That hasn't happened yet. Doesn't look very likely to happen, because similarly to shares, Bitcoin is one of the places somebody can put money and they can get some sort of return on it. Price is likely to increase. It's obviously significantly higher than this now. This is last week's chart. There is huge amount of interest in Bitcoin among large companies, particularly you've heard probably most of you of Tesla's purchase of $1.5 billion worth of Bitcoin. And this sort of thing combined with DeFi, decentralized finance, crypto, earn schemes, superchargers, and so on and so forth, ways to earn interest on your crypto. I mean, likely to mean that Bitcoin is overshadowing many instruments. Bitcoin, that is to say, and other cryptocurrencies are overshadowing instruments for quite some time to come, expect. But of course, cryptocurrencies are extremely risky, and especially CFDs with leverage on cryptocurrencies are extremely risky. So it is something to be crucially monitored is, of course, sentiment. Sentiment for crypto can change very, very quickly. And at this price, there really are a lot of question marks when you can't really spend it. You can spend it, but it would be a bit strange to spend Bitcoin because its value is simply so volatile and it's quite expensive. So there are really a lot of question marks, and there are a lot of risks, of course, getting involved in crypto at the moment. So that's about it from me. I would like to say thank you very much for having listened. Hopefully that you found this reasonably useful. You've learned at least something new. And I would like to say, if you have any questions, that would be brilliant. Please do ask me any questions that you might have, and I'd be very happy to answer them, or at least attempt to answer them. I think, yes. Microphone is on. Yeah, if you have any questions, feel free, please. Or if you disagree with me, that's also fine. You're allowed to disagree. أو لو حد لسبب ما مش عايز يسأل بالإنجليزي اتفضل يسألني بالعربي. بتكلم كلمتين عربي أو 3، فممكن أرد بالعربي وأترجم إنجليزي عشان كل الناس تفهم. اتفضلوا. أي أسئلة? Any questions? You're welcome.
Michelle?
Yes, Mr. Khaldoon. Yes, please.
How are you? Can I speak, please?
Yes, you can speak. Yes, feel free.
Okay. شكرا لك على المحاضرة القيمة. Thank you for this session. And I want to ask you, there is another coins, not only a Bitcoin. What about the price for it? What about the future for it? And really that I want to ask you also about the gold. We hear that maybe the gold will be in the first quarter of this year, it will be the price for it will go high. Can we listen to you from any answer from you, please?
Yep. Well, Bitcoin, what's going to happen to Bitcoin in the future? As I said, it is quite uncertain. This is just my personal opinion. I'm not telling you what to do. I think that Bitcoin, its fundamentals look very strong, and technically it is obviously overbought, but still it does look quite strong. I mean, I personally hold Bitcoin. I'm not planning to sell it anytime soon. I'm planning to keep it. That doesn't not mean that you should same. That's just what I'm doing. You need to just take my word for it, think about it for yourself. But I think, yeah, definitely there's room for Bitcoin to go up further. And I'm not expecting a crash in Bitcoin. Definitely not. How high would it go? I don't know. I don't have a crystal ball, I'm afraid. So I don't know how high it's going to go. But I certainly am not expecting a crash for Bitcoin. And for gold, I would say, again, it looks pretty positive. We're just waiting for some kind of catalyst for it to go further up. Because there's just not really a whole lot of reason to sell gold, given that we're not out of the crisis by any means yet. Interest rates remain very, very low, zero in many developed economies. So it's just not really that much reason for the average person to sell any gold they might hold. So it looks kind of positive, I think. Does that answer your question, Mr. Khaldu?
Thank you. Thank you.
Any more questions? I think we do have about half an hour, so.
No question from anyone?
Don't feel shy. I don't bite. I'm a trader. I'm not a wild dog. But seriously, if you have a question, then let me know, please.
Okay. If there is no question, thank you, Michelle. Thank you for your participation. Hope all of us were successful with this expo and conference, and hope to see you in the Forex Expo, inshallah, in May, inshallah. Thank you.
Inshallah,
thank
hopefully.
You.
Yeah. Thank you very much, everyone. Happy trading. See you.
Bye. Bye. Bye.